Hi there. We are in mid-July 2022. There's a lot going on in the world. There's a lot going on in financial markets, the world around us. I have some pretty important things that I think you'll find interesting. Share some ideas, share some updates, things to keep in mind. This is primarily designed for our investment management clients. So if you're not an investment management client, some of the things we may talk about may not make much sense or be as familiar. Hopefully for our investment management clients, this will make more sense. So if you're watching this, you don't know me, my name is Adam Goodman. I'm an independent advisor here in the Las Vegas, Nevada area. We emphasize comprehensive planning. I have a lot of different designations, education. Maybe a couple more slides about that, but again, let's jump right into the content primarily for our existing clients. So I want to update you on current market thoughts, environment, considerations. 3 things for investors to consider: impact on financial strategies. We'll walk you through an example, a real life example of a structured income note that we use for some clients. And as always, when you're listening, I think it's important to think about, how does this relate to you, right? And for those of you that already work with me, reach out to me, let me know, ask me questions. Hey, you were talking about this. Could that make sense for me? What about that? And we try to be as proactive as possible. And with many clients, we have lots of conversations like that. But we do have a handful of clients where we reach out and we don't always hear back from. So if that's you, then you need to be reaching out to us, keeping us abreast as far as what's on your mind, you're concerned, any life changes, things like that. And as we've grown over the years, it gets harder and harder to stay on top of things for each individual client. Even though that is a top priority. So if you feel like we're not doing that, I'm not doing that, let me know. See what we can improve. Okay. So anytime we're doing general education, group presentation, I have to share compliance and educate, share with you that we're not talking to a specific person. Some of the ideas may not be relevant for you. Oftentimes the right choice for one person is not always the right choice for someone else. If you've heard me talk before, which most of you probably have, again, this comprehensive planning picture. So we're really going to focus on the investment planning, but it really crosses into income planning and insurance planning. So these 3 parts of the disc, I think what's going on and some of the changes could impact. The other 2 areas, not so much today, but always to create the best outcome. It's always suggested to be aware and to think about things through that spectrum. At least if you have the estate planning squared away, for some people that could be changed over time, but the other 4 areas I think are much more fluid, at least for us, right? I can add value in the estate planning as far as recognizing potential gaps and connecting, but I'm not an attorney. I don't prepare trusts, legal documents, etc. So let's take a look at the current market conditions, environment, what's happened so far this year. So for the first half of the year, it's the second worst time going back, over almost 50 years for a traditional investment portfolio. And when I say traditional, so the traditional asset classes are stocks and bonds. Over the years, many other asset classes have been created. More and more people have access to them. More and more people are familiar with other options. More and more people are using other options. For our clients, we've been utilizing many other options for many years and been very wary of bonds specifically for several years. And so, thankfully, most of our clients have not experienced this type of thing, but if you're not a client and you've experienced this and your advisor doesn't have any other ideas or solutions, then that may make sense to seek out some other conversation, some other advisors that may be more knowledgeable, more experienced, have access to different tools, know how to use different tools. If you've been doing things on your own, this might be a reason to stop doing it on your own, right? Or to get access to some of the tools that you don't have access to. But yeah, there's a lot of people talking about is the 60-40 portfolio broken? And that's not really what we're going to get into today. It's just, I think it's always interesting, the idea of, is this time different, right? And I think that's a very dangerous idea to buy into. I think that there's similarities, but each environment generally has its own challenges, whether it's, an oil crisis, whether it's unemployment, whether it's federal stimulus, whether it's COVID, whether it's a war type situation. So I think the interesting thing here, the interesting thing that we've been going through is we had the supply shock, COVID, stimulus, and then you add on top other factors. And now you have the Fed coming out and really trying to fight inflation, right? And what they've been doing to do that, so this is the main story of the year, is raising interest rates. And so generally, especially growth stocks, they don't like higher interest rates. They don't perform well in that type of scenario. But it's interesting because if you look at other data, it'll show you that they found a way to work through that, right? And generally, there's no guarantee that anything in the past will, occur again, but you can see that generally it doesn't go in any one direction for too long of a time frame. Although this is, a couple of years, but so yeah, we don't know. Are we talking about a couple more months? Are we talking about 6 months, a year of working through the current challenges, or are we going to get to the other side quicker than people are thinking or talking about? I think that's an interesting concept to think about. But keep this in mind. So interest rates have been rising, and equities have not done well. Say exactly for that. There could be other reasons as well. Rising interest rates do not, they negatively impact bond prices. So if you own bonds, this is the reason why your bonds didn't do well. The sentiment, I think this is it's hard to measure specifically, like what does this mean for XYZ, company or what, but I think for the general market conditions, I think that, people talk about things like, oh, well, earnings impact, stock prices and interest rates. And, I think that there's a degree of truth in all that especially those things should, but ultimately it's buyers and sellers, right? It's supply and demand. If there's more people that want to sell things than there are buyers, you make sense, prices are going to go down. If there's more buyers, so sentiment, right? So generally, when you get in environments like this, everybody's negative. Nobody thinks that good times will happen again, somewhere along those lines, right? So, keep that in mind. Stocks, that's the major stock index, S&P 500, NASDAQ, those are the major ones. The NASDAQ is down the most of any of the major indexes. It's the largest, that is, has the largest concentration of technology. So you can see here, going back over 20 years, there's not a lot of time periods that the S&P is down. This is called the 200-day moving average. So it's a lot lower than it normally is, right? I think we understand, there's some logical reasons why that should be, or is the case. So a couple things I would say is that, just because it gets there doesn't mean that you instantly, if you were to buy, things that an investment that would be, the price change would correlate with the S&P 500, that you're instantly rewarded. It's instantly a positive move, right? You could see here, if you would have done that here, it would have taken a while, but obviously you would have felt great. Right? So that's I think that's an important concept to think about. Is like, it's always like, what's going on with you and your life is so much more important, I think, than a lot of these things that we're talking about. But people always ask questions. What do you think is going to happen? The economy and the recession and the stock market. That's what we're talking about. But always dial that, how does this relate to you? Right? What's your timeline? What's your risk tolerance? What's your risk capacity? So a lot of people say they're long-term investors. Well, again, if the past is not we can't rely on the past that will occur again in the future, but anyone that's bought anything correlated to the S&P 500 in the past, in this type of situation, has been rewarded on a multi-year forward basis, right? So I think that's something to keep in mind. Leave that up for a second. I'm not going to read that. So things I think could make sense to look at and consider is rebalance and rotate. So rebalancing, so you have an allocation where I have 10% in growth stocks and 10% in value stocks. If that was your situation coming into this year, I guarantee you, if you look at your portfolio, you don't have 10% in each of those. The growth stocks are down, the value stocks have held, if not higher. And so rotating, so rebalancing is just getting back to those original allocations. That's something I look at on a fairly regular basis for our investment management clients. And rotation is when you may even change the allocations, right? So you may decide, hey, it doesn't make as much sense to have 10% in that allocation. I'm going to reduce that to 5 or maybe even 0. And so that's not something that is regularly done. But I think, as you can see in the past information, what we're going through, we're not going through regular times. It's not like so unique and different, right? These types of dislocations or unexpected things, I would say that it's pretty reasonable to expect something like this at least once or twice a decade, sometimes a little bit more, sometimes a little bit less. Again, it's not exactly the same reasons, right? But it's a shock, and it unexpected. May also hear things like as black swans, So in that type of environment, I think it's reasonable. That probably rotation is probably not something for most people to do on their own. For those of our clients, you may have seen me making some adjustments, adding some positions to some things that you didn't have last year. So that's an example of what I've been doing as far as that rotation. And again, keep in mind that looking back, it's important to have a long-term timeline with that. So if you do regular Roth conversions, a lot of our clients do. A lot of times that's done maybe toward the end of the year. But I think anytime where markets are down, it could make sense to look at that. And we're in that type of environment. So if you're going to do it anyway, right, this year, and you regularly did it in November, December, it might make sense to look at that. If you're not going to do it in July and August, have a good reason why you're not. So, and of course, if you had a life change, your income is down this year, that may create an opportunity. If everything, you have plenty of financial cushion, but if you retired, you've lost your job, left your job, so if there's an income change, those are annual opportunities. Right? Annual contributions, for those of you that are still working, you're making regular contributions to IRAs, Roth IRAs. If you're going to do it anyway, and a lot of times people tend to do that maybe toward the end of the year, or they wait until they file their taxes the next year. But if you can do it now and you find something attractive to put it into, then do it now is what I thought. So as we continue on, I think it's important to have a frame of reference. And so when I talk about different financial strategies, we call them strategies, solutions. I just think of them as different tools. And it's not that one tool is better than another tool per se, but quite often there's a better tool for a specific situation, for a specific person. And I really see myself over the years having developed into being a really knowledgeable financial handyman, someone that has access to a lot of different tools, someone that can recognize situations where a certain tool is more likely to create a better outcome, a desired outcome, understanding that in most situations, there's no guarantee on that. So we're just talking about, we talk about the highest probability of success, understanding the range of probable outcomes. And so Here's a visual of some of the asset classes that we see making the most sense and being the most attractive. So equity strategies, you can see that there's no bonds on here. Index linked, alternative, structured notes, and index insurance. So there's several other things that we've used over the years that we're not utilizing now, just because we see other things being more attractive. And so we're independent, we have access, we're not restricted or mandated on, we have to use one of these more than the other, or we can't use one, but there are many advisors that are in that type of situation. So if you're not a client, you're watching this. So the reason why I wanted to tee that up was that as I share this, and so we call this our defined risk categories or strategies, and then implementing it within the overall plan for each individual. And so if each of those 5 slivers would correlate to one of these 5 things. So within in index insurance, we have index annuity and index life. So not expecting you to understand all this information or be able to see it all on here. It's just that this is more of a talking point. This is more designed for individual conversations, but you may, if you're not familiar with this, you may have some questions and you want to, hey, how does this relate? Could this relate for me? Would this be better for me? I will point out a few things on here. So anything with a check here is an investment. So crypto, tech focused. This could be things like ARKK, things in that genre. Traditional stock investments could be our dividend, our stock, our growth stock strategies. Structured notes, that's an investment category. And then over here, we have insurance products. So these are not investments. So this is fixed. So for those that want some principal protection for some portion of their dollars, you're generally looking over here. Investments don't have that. Now, one of the things that's interesting is that this option here is an investment and an insurance product. And so we've talked about that a lot, is that the investment world and the insurance world are really, over the years, coming closer and closer together. And not only is that important to in my experience, to be able to utilize both strategies, but to do the planning up front so you can understand what your personal risk tolerance is, your personal risk capacity, what you're trying to achieve, so that you're utilizing the right tools to hopefully create the best outcome for yourself. So most of our clients are going to have several of these strategies, if not the majority of them. So the newest ones, so everyone seems to be familiar with this, right? And many clients are familiar with the index insurance. Structured notes, a lot of clients use, but they're not always as familiar, don't necessarily understand and as much. And so we try to help clients with to the degree that they want to understand. And so there's a little bit more material I'll share with you in a minute. And then this category we added last year, and it's a nice bridge, And so from the risk spectrum, one of the things I look at, if we want to go down in risk, right, then we're going left to right, right? So in general, if we're increasing risk, we're going from right to left. So what I just talked about is the investment planning, but that could also impact the income planning, right? So very important to keep in mind, are you regularly taking distributions? And if you are, your strategies will likely be different than someone who isn't, okay? So I shared with you that interest rates have been rising pretty dramatically. And so there's a couple of product categories that have benefited from that. I'm gonna come back to this because I wanted this slide first, but so CDs, fixed annuities, fixed index annuities, those products have benefited from rising interest rates. More specifically, but where you've seen the improvement is in the fixed and fixed index annuities, where those are priced more tied to the 10-year treasury rate. Bank products, that's that lagging. So you could see that the 10-year treasury is much higher right now than the federal fund rate, because they would say markets are forward looking, right? And so the categories that haven't done so well in the rising rate environment so far this year, as we talked about, is bond and most stocks, right? So for those of you that do like these categories, or it's been a long time since they've been as attractive as they are. So here's an example of a 7-year fixed index annuity. All annuities can provide lifetime income, but some annuities are designed for what I call safe accumulation. So this is one of the ones that we utilize for safe accumulation. We have access to many different companies. We use a handful of different products. Sometimes over the years that change, but we are pretty limited as far as what we can share with people in a group setting, as many of the informational brochures or resources companies provide are not approved for group use, but this one is. And we have many clients that have this product that 4, 5, 6 years ago. So if that's you, to give you a frame of reference, right? If you look at your renewal letter from Great American or your annual statement, you can compare and you'll see that I don't think we have any clients that have their current rates as high as these rates, right? Because it's priced on where it was at the time. So, right, interest rates are higher now than they've been in many years. And so you can see the growth, but so the cap is the most that someone could earn in a 1-year period. And with these products, again, we're not going too deep, but if you don't know about these products, the reason why people like these is because they have a guarantee to not lose any of their principal based on the insurance company. So you want a reliable insurance company. That guarantee is based on their claim paying ability. So participation rate, so if you have that, you're uncapped and you get that percentage of the index. So we really like about this, and then each year, if you have a 1-year segment, we can make a change. So what I really like about this product is there's a lot of different asset classes to use for indexes. So S&P, real estate index, ETF, and then also gold, and then some other uncapped strategies. So, but again, if you had money on the sidelines, if you recently sold some real estate, if you got an inheritance, you feel like, well, it's not a good time to put money to work. I'm scared of the market. Like, okay, maybe maybe that thought makes sense, but maybe there are other non-market options that could be very attractive for you, whether it's what I just showed you or whether it's a fixed annuity. We're seeing rates that we haven't seen in a very long time. So just reach out to me if you want to talk more about that. Okay. So as we're wrapping up, I think that hopefully you feel more confident and more comfortable understanding what's going on in the economy, and again, focus on your specific situation, your timeline. Make sure that you have plenty of risk capacity for whatever comes, as well as your emotional well-being is your tolerance. But I think that for a lot of investors or a lot of individuals that don't have access to all these different tools and a guide, advisor to be with them along the way and to coach them as far as what tools are right for them and which tools are not, how to put it together. I'm concerned for, in that I'd be much more concerned in that type of situation, right? So I hope this has been valuable. I hope this has been helpful. Reach out if you have any questions, how this specifically relates to you. If you're not a client and you'd like to discuss that, learn more about our services and et cetera, here's our contact information. Happy to have that conversation. Take care. Talk to you again soon.